What's up? Today I'll be looking at VOO versus VTI. We'll do a deep dive and look at factors such as market cap exposure, sector exposure, industry exposure, top holdings, ETF overlap, cost, tax efficiency, performance, risk-adjusted returns, and analyst ratings. We'll talk about the slightly different objectives of each, and at the end I'll give my own opinion for those that care about my opinion. If at any point you decide you like this video and find it helpful, don't forget to hit the like button, because that's what it's there for. And also feel free to lurk below and check out the links in the description. You can get free stocks, free crypto, cash back on purchases, and other fun stuff. Without further ado, let's get started. Conventional wisdom tells us to own a low-cost, diversified index fund, to dollar-cost average, and to hold for the long term. We hear quotes such as, time in the market beats time in the market, to not look for the needle in the haystack, but to just own the haystack. AKA, don't try to pick individual stocks, but to own a diversified portfolio of stocks. Quotes such as, the only people that die on the roller coaster are the ones that jump off. In other words, the market will be volatile. Don't panic sell your stocks when the market goes down. Because given enough time, a diversified portfolio of stocks will come back. And those downturns can be some of the best buying opportunities. AKA, be greedy when others are fearful. Be fearful when others are greedy. Usually VOO and VTI are the ETFs that these financial talking heads will mention most frequently. In short, the difference is this. VOO tracks the S&P 500 index, the top 500 largest U.S. companies based on market cap. VTI tracks the CRSP U.S. Total Market Index. So VTI not only holds the top 500 largest companies, but also mid and small cap companies also. An investor like Jack Bogle, the founder of Vanguard, would advocate for holding a fund that tracks the broad market, while Warren Buffett has said before that the best thing for most people to buy is just an S&P 500 index fund. To be eligible for S&P 500 index inclusion, a company should be a U.S. company, have a market capitalization of at least $11.8 billion, be highly liquid, have a public float of at least 10% of its shares outstanding, and its most recent quarter's earnings and the sum of its trailing 4 consecutive quarters' earnings must be positive. So you can say that the profitability requirement will lead to the index holding higher quality stocks. Also, large cap stocks tend to be more safe and stable. But you can also argue that you miss out on the diversification value and potential price appreciation of holding small and mid cap stocks. For a company to be added to the CRSP US Total Market Index, it has to have a market cap of over 15 million and needs to meet minimum liquidity requirements. So you can make the argument that VTI's index allows you to get earlier exposure to smaller cap companies on their rise to becoming large caps. Like say Tesla. You can also make the argument that it allows you to ride the losers further on their way down, like say Pets.com. Both of these ETFs are by Vanguard, so you know they're going to be low cost and well managed. So let's skip regional exposure because these are all US equities. Those that want global exposure should check out VT. This ETF tracks the world stock market, so not just US equities, but also international equities. Also, some investors choose to own a blend of VTI and VXUS to save on costs. VXUS is an international ETF, thus combining VTI and VXUS can simulate VT and save on costs. Well, at least the costs on the US portion of the ETF. VT charges 8 basis points. VXUS also charges 8 basis points, but VTI only charges 3 basis points. So owning both of these ETFs gives you more control over your asset allocations. But anyway, the point is that this gives you international exposure for those that value the added diversification that it brings. The US market has outperformed international markets over the last decade, but this is not guaranteed in the future. Also, some prefer to keep their money domestically because, well, America. So moving on to market cap exposure, VOO is 84% large cap and only 16% mid cap. VTI, on the other hand, is 72% large cap, 19% mid cap, 6% small cap, and even has some micro cap stocks. Again, this is the big difference. VOO focuses only on the largest companies. VTI focuses on the whole market, including the smaller companies. Granted, it is still mostly large cap, so these ETFs have a ton of overlap. So for that reason, there is no real reason to own both. So ultimately, the debate is, do we want to focus just on the large caps, or do we want the added diversification of the mid and smaller size companies? Large cap companies tend to be more stable, transparent, dividend paying, long-standing companies with more resources that can better hold up in and withstand a market crisis. Small cap companies tend to be a bit more risky and volatile, but they can also have attractive upside potential and historically outperform large caps in the long run due to the size risk factor premium, essentially meaning higher risk, higher return. Granted, big is not always safe, small is not always risky. These are aggregate generalizations as viewed over a long time period. So let's move on to sector and industry exposure. These ETFs do not target a specific sector or industry, but they are market cap weighted and therefore give more weight to the largest companies. Some of the largest companies in the world are tech companies, so both of these ETFs have a good bit of exposure to big tech, both close to 30%, and given that VOO has a higher concentration in the largest names, it has slightly more exposure to information technology. Moving down the line, we have exposure to consumer discretionary, healthcare, financials, etc., the rest of the market. Moving on to top 10 holdings, as expected, the top holdings are identical for both. Apple, Microsoft, Amazon, Tesla, Google, Nvidia, Facebook, Berkshire Hathaway, and JP Morgan. Again, VOO has more concentration in the largest names. The most significant thing to point out here is that VTI has over 4,000 holdings, where VOO only has 500. So VTI has an extra 3,500 holdings. But this does not necessarily mean that they will perform significantly differently. We can get a better idea of just how similar these ETFs are by looking at the overlap. We know that they have 500 overlapping holdings, but that overlap turns out to be 80% by weight. So if someone didn't understand how market cap weighting works, they might expect the ETF with an extra 3,500 holdings to perform significantly differently. When we look at the performance, we'll see that this is not the case. And we'll look at that later. When it comes to cost, both of these ETFs are beautiful. The expense ratio is the annual cost of management. Both only charge 3 basis points, meaning that on a $10,000 investment, you would only lose $3 a year to fees. This is about as good as it gets. This is why the people over at R Bogleheads on Reddit love these ETFs, because you get broad market exposure for a dirt cheap cost. Granted, they tend to like VTI more because it gives you more diversification. But in either case, the less money you lose to fees, the more money you can keep compounding in the market to make you more money. Tracking difference shows how a product's performance compares with that of its benchmark over a stated period of time. It's a good report card for how well a manager is doing. It depends on factors such as expense ratio, rebalancing costs, sampling, cash drag, security lending, and rebalancing timing. Given that fees are included, tracking difference is typically negative. Both of these ETFs track their index very well with only a median 12-month tracking difference of 0.02%. Rest assured that you are getting all that the indices have to offer with these ETFs. Spread is the measure of liquidity and the cost of trading shares, essentially the difference between the bid and ask price. If the ETF is popular and trades with robust volume, then bid-ask spreads tend to be narrower. But if the ETF is thinly traded, or if the underlying securities of the fund are highly illiquid, that can also lead to wider spreads. Both of these ETFs are very large and liquid, and thus have spread costs that are essentially zero. However, VTI has slightly higher spread costs. This is probably because of the higher percentage of small cap stocks, which tend to be more liquid. We can also look at turnover ratio. This is the percentage of an ETF's holdings that have been replaced within a given year. Anytime you sell a stock or an ETF for a gain in a taxable account, you have to pay capital gains tax. If you hold for more than a year, you pay the more favorable long-term capital gains rate as opposed to the higher short-term capital gains rate. So the less turnover, the less taxable events. The turnover ratio of VOO last year was 4%. The turnover ratio of VTI last year was 8%. Both of these ETFs have low turnover, but even though VTI has a little bit more turnover than VOO, these are mostly the small caps moving in and out of the index, so likely a very small amount of the ETF weighting, and therefore not a significant tax hit. At the end of the day, these are some of the most cost-efficient ETFs that you can buy. So let's compare the performance. We see that both of these ETFs average 27% over 3 years, 18% over 5 years, and 16% over 10 years. So the market as a whole has had a great run recently. The average return of the S&P 500 from 1926 to now is about 10 to 11%. VOO has slightly outperformed VTI during the 3, 5, and 10-year time frame. I think a lot of this has to do with the outperformance of mega cap tech over this time period. VOO has slightly more weight in the mega cap tech names. Again, small caps tend to outperform large caps over time, so for that reason you might expect VTI to outperform over a long enough time frame. And if we trace their indices back to 1972, we see that VTI would indeed have slightly outperformed VOO had these ETFs existed back then and existed in their current indices. VTI has actually changed indices 3 times. So we can expect VTI to slightly outperform over time, but at the cost of slightly more risk and volatility with the small caps. But you also get decades like the past 10 years where VOO outperforms. But either way, if you owned either of these ETFs over the last 10 years, you're probably pretty happy with yourself. They've done very well. So just for fun, let's look at risk-adjusted returns. To analyze risk and return, we can look at Sharpe ratio. The Sharpe ratio adjusts a portfolio's past performance or expected future performance for the excess risk that was taken by the investor. A high Sharpe ratio is good when compared to similar portfolios or funds with lower returns. However, the Sharpe ratio uses volatility to determine risk, which is not an unreasonable assumption, but also not a perfect comparison. VOO currently has a Sharpe ratio of 1.05 and VTI currently has a Sharpe ratio of 1.01. As we would expect, they are very similar. A Sharpe ratio of 1 is good. That's about what you expect on the market. It makes sense that VTI has a slightly lower Sharpe ratio. The returns are slightly lower over the measured time frame, and the volatility is a little higher because of the small caps. Let's compare the trailing 12-month dividend yields. The TTM yield gives you an idea of the dividend payouts over the last year. It is the sum of the dividend payouts divided by the ETF share price. The TTM yield for both is as follows: 1.26% for VOO and 1.22% for VTI. It's not surprising that VOO pays a slightly higher yield as it holds a higher concentration of large caps. Large caps are more likely to pay dividends to shareholders. Small caps are more likely to reinvest that cash back into the growth of the business. Everyone loves a good dividend, but they do come with some tax inefficiencies as they are essentially forced distributions and thus trigger taxable events. They do come with the opportunity cost of not being reinvested back into the business, and additionally, it can be very tempting to spend those dividends as opposed to reinvesting them back into your ETFs to continue the power of compounding. But anyway, I did a whole video on dividends and dividend ETFs that you can check out if you're interested. Lastly, let's look at analyst ratings. VOO got an A from FactSet and 5 stars from Morningstar. VTI got an A from FactSet and 4 stars from Morningstar, but it's 5 stars in my heart. So what are my thoughts? What can I say? These are both great ETFs. They are low cost, efficient, well diversified, and well managed with a long history of steady proven performance. I feel like I've used the word slightly a million times in this video because these ETFs really are so close. Actually 13 times to be exact. In short, I would say that the objective difference is this. VOO is for those seeking lower volatility large cap stocks. VTI is for those seeking more diversification and expected higher long-term returns at the cost of slightly higher volatility. Also, those that want to customize their total market exposure can own a blend of VOO and VXF. VXF is a mid and small cap ETF. Maybe someone would want more mid and small cap exposure and less large cap exposure, so they would own more VXF and less VOO. VTI can't give you this flexibility. However, some investors may not have the stomach to hold a small cap ETF individually. They may see the volatility and make rash emotional decisions at the wrong time. FOMO buying high and panic selling low. The large caps in VTI can shield you from the volatility of the small caps, but at the end of the day, sometimes it's better to just automate your investments, dollar cost average, and pay no attention to the day-to-day volatility. Short-term investing is close to gambling. Long-term investing is a reliable generator of wealth. Essentially a transfer of wealth from the impatient to the patient. But if I had to pick one, I would pick VTI for the diversification and expected long-term returns. I've talked a lot about the VTI volatility, but it really isn't that volatile, and I'm in it for the long term anyway. If you're going to go for a broad market strategy, as in diversified across all market sectors, it makes sense to diversify it across market cap as well. So I own neither ETF, but I basically own VTI through a combination of the C fund and the S fund in my TSP, which is basically the government 401k. This combination of the C and S funds is similar to the combination of VOO and VXF, as I mentioned before. The broad market is really the core of my portfolio, and from there I extend myself further out on the risk curve with smaller amounts of money in more concentrated positions, such as tech ETFs, individual tech stocks, and also my crypto portfolio. But the broad market will always be the bulk of my portfolio, as it's proven to be a reliable investment given a long enough time horizon. We're not talking about month to month or year to year, but decades at a time. The only way to be more diversified across equities than the broad US market would be to own a total world stock market ETF, like VT. So I may do a video on this at some point for those that are interested. Just another perk of subscribing. If you found any of this helpful, consider hitting the like button and subscribe for more content like this. Also consider checking out the links down below. Currently down there you can get 2 free stocks with Webull, potentially valued up to $2,300, $30 with M1 Finance, $50 of Bitcoin with Celsius, where you can earn interest on your crypto holdings, and $30 with Rakuten, where you can get cash back on online purchases. However, these promos do change over time, and as always, this is not financial advice, just entertainment purposes only. So thanks, and I'll see you in the next video.